Hi there, just read this disclaimer please. Hey guys, so today I thought we'd have a quick look at how my investment trust, the income focused dividend trusts that I own, how they are progressing towards getting their dividends covered fully by the dividends or income that their underlying assets pay. Since the pandemic started and all the dividends got cut, investment trusts are using their dividend reserve, the revenue reserves, and in some cases their capital reserves as well, to keep paying a progressively increasing dividend. So City of London here, you can see it's still increasing the dividends, but this number here, dividend cover, shows you that actually the income they're receiving has gone down in these 2 years since the pandemic started. So I wanted to have a quick look at how they're progressing towards getting this dividend cover back to 1 or above 1. So what I've done is I've gone to this section of Hargreaves Lansdown, got the dividend cover for my main income paying trusts, and I've just collated it in a spreadsheet here. So what we can see here is that, so for City of London, for starters, it went down from 1.06 the year before the pandemic to 0.83, and it's back up to 0.89 now, so it's making progress towards getting back to 1. And obviously 2022's isn't there yet because it's too early for that information. So I mean, that wasn't a massive reduction. I mean, when I read the annual reports of City of London and kind of watched Job Curtis, the manager, talk about it, he took the tact of some of the more growthy stocks. Like I heard, there was 2 stocks that I remember in particular hearing him say that he'd sold out of. I think one of them was Spirex. Oh, I forget the name of it. Anyway, it was a growth stock that I know they've held for a long time in the City of London. It probably was yielding 1% or less. And there was another stock as well that he mentioned selling, which he obviously then ploughed them low-yielding stocks into higher-yielding stocks. And I know that he's always owned Microsoft for a long time as well, so I wouldn't be surprised if he'd sold some of Microsoft and put it into higher yielding stocks. So I think his tact was keep 2020's dividend cover as high as possible, given all of these slashes to dividends. But then I've also, because the reason I mention this is that when we come to Lowland on the next line, you'll see that the dividend cover went down a lot more in Lowland than it did in City of London. The dividend cover also started off higher, look, 1.14 the year before. And this kind of makes sense because at the annual general meeting that they had recently, they did talk about, rather than doing what Job Curtis did in City of London, their approach has been to not change their investment strategy. So if they had lower yielding, growthier, or companies with more growth prospects that had a lower yield, they didn't necessarily sell them to get 2020's dividend cover higher than it is there. And that's obviously reflected in the much lower number of 0.56. Part of that is also probably due to the year-end date, which is July, 3 months later. So in 2020, Lowland's financial year had 3 months extra of the pandemic. Yeah, City of London, if you go from 30th of June 2019 to 30th of June 2020, that's only 3 months, because the pandemic kind of hit in March, didn't it? So that's when all the companies started cutting their dividends. City of London only had 3 months of this year with the pandemic going on and companies all cutting their dividends, whereas Lowland had 6 months. So this is why these numbers that I'm looking at are actually quite difficult to compare, because it's affected heavily by financial year dates as well. So that's part of the reason, but so I think it's not just the difference here between Lowland and City of London isn't just the financial year. It's also what I mentioned about their different approaches as well. So as you can see, there's the progression from 0.56 to 0.71. So obviously it's a bigger bounce back as the dividends came back. Now again, merchants, their end of year date of 31st of January means that the pandemic barely even touched them in 2020. So they've had a reduction down to 0.68, but we haven't had the annual report yet. So the kind of bounce back that we've already seen here in these 2 years for City of London and Lowland, we haven't seen that yet. That will start to come in 2022, but we haven't got that info yet. Murray International has done a lot better. It didn't have as much of a fall, and it's also almost back to being covered already. Yeah, so here's a rough estimate of what their yields were before the pandemic on the 2nd of January 2020. And Murray International, because what you would expect is, the higher the yield is, the more susceptible they would be to dividend cuts, because that would suggest to me that the companies they own are paying out a bigger portion of their profits in dividend compared to the higher growth ones. And similarly for Henderson International, had a lower yield, and it's had a kind of similar bounce back really. It's only now 0.95% covered compared to Murray International here. And then Henderson Far East Income, I mean, this has just booked all the trends because it's got massive, it's the highest dividend, but it didn't even had to use its reserves in 2020. It's crazy. And then in 2021, it's only used the reserves for 1%. But I mean, when I read the annual report, it said that actually that was only really because they issued a load of equity. So they put out extra shares, which meant that the dividend, the revenue they'd received in earlier parts of the year, then had to be used on more shares. So it's really not really even uncovered this dividend. So yeah, it really booked the trend, but I mean, doesn't mean that it's been doing well, this trust, because if we look at it, because as usual with Henderson Far East Income, even though it's been doing well on the income front, the share price has not been doing well at all, which is why the dividend yield is so high now at 7.89%. Well, that's there. I estimate it as, on a forward basis, I estimate the yield as 7.96, which is ridiculously high. But it kind of baffles me that it's still got dividend cover so high though. And then Scottish American. So for an income trust, it had a very low yield for considering its remit of income. But it's kind of it's kind of proving itself here, because the dividends never really went that low. The cover was only ever as low as 0.95, and they're already back to covering it. Now this is just my estimate, because this info here, so I took it from here. The earnings per share were 12.79%, and I've used that to estimate a dividend cover of 1.01. Hopefully my calculations are correct there. But yeah, it's already covered. Same for Finsbury. I mean, this was kind of more of a growth trust anyway, really, so it's no surprise that these dividends that were getting paid were quite resilient. The cover only went from 1.1 to 0.99. I mean, part of that was helped by the fact that in this year, Finsbury just kept the dividend flat. So here's the dividend increases. So obviously that was helped by the fact that actually they didn't even increase the dividend at all. They kept it flat. But yeah, it's already covered. Brunner, BUT, did have quite a big decrease, but it's already got it covered the year after in 2021. And BlackRock smaller, massive decrease in the dividend cover there in 2021. I mean, this was another example of the year-end date heavily affecting it, because 28th of February, that's almost perfectly timed for COVID not affecting this year's dividend cover. But obviously, that means that it's perfectly badly timed for 2021's cover, because that is massively down. But also it's just the fact that they're smaller companies. So yeah, BlackRock's smaller and has a massive recovery needed. But they did keep increasing their dividends by pretty decent amounts really, 4% and 2.46%. Nothing compared to the years prior. The years prior, BlackRock smaller companies was increasing the dividends by 20% for quite a few years. So obviously it affected it, but it's still increasing the dividend. So they must have confidence that this really low dividend cover is going to bounce back this year and maybe the year after. I mean, yeah, I just put this info in here just to show that, with some exceptions, the lower the yield going in tends to be, so these were pretty low yields and they're already covered in 2021. These bigger yields here aren't yet covered in 2021. Oh, so what I've got here is, I've just calculated here the percentage increase, or just a rough estimate of the percentage growth needed in the dividend to get to a covered state. So for City of London, well, I'll show you the calculation there. It's 1 minus the dividend cover divided by the dividend cover. Because if you think about it, to get to 1, that needs 0.11 divided by 0.89 is the percentage increase needed to get to a dividend cover of 1. Actually, it needs a bigger increase because City of London probably will increase its dividend next year, but as well, by probably by a really small amount. But to get to a 2021 covered dividend, it would be a 12% increase. And as you can see here, Lowland still has a big increase needed, 40%. So it's probably going to take a few years for Lowland to get the dividend covered. City of London, if it's not covered next year, I imagine it will be covered the year after. That's my estimate. And merchants, similar to City of London, just a different year-end date is causing this number to be so high. So the massive increase that Lowland had here from 0.566 to 0.71, we're probably going to see that in merchants. So I wouldn't be surprised if this had a massive increase next year from 0.68 to maybe 0.8 or something, 0.9. Just because of the timing of the year-end dates. And Murray International and Hint, pretty modest increases are needed to get their dividend cover. So that's pretty good. And HFL is already covered pretty much. Only a 1% increase needed to cover that one. And Sane, again, is already covered. That's why that number's negative. So it doesn't need these three. Already covered, so they don't need any growth needed to cover their dividend. So hopefully that would suggest that some bigger dividend increases could hopefully be due for these three. I mean, we've already had Scottish American declare a big increase, pretty big increase for 2021 of 5.63, which is pretty good for them. Brunner are covered now, so I would like to see those two, having had 2 years of pretty nominal rises of 0.4 and 0.45%. Hopefully we'll be able to see maybe a 5% increase from them from now on. BlackRock smaller. They've still been increasing it, but they've got such a massive jump to go. Hopefully we'll see a massive rebound in 2022's dividend cover. But I wouldn't. So obviously, the fact that it's not covered in 2021 suggests to me that it's going to be another small increase, maybe another 2%, since they gave us a 2% increase last year. Now, Aberdeen Asian smaller companies, Asia Focus used to be called smaller companies. These numbers don't make sense to me. So I think there's something funny going on with the accounts. I don't think we can really read much into these three numbers here. Because as I understood it, you could only hold back 15% of your revenues for future years. But that number there would suggest it's too high. That number there would suggest that like 1/3 of their dividends were being kept back in 2019. And the same for 2020. So for me, I think something weird is going on. Something I don't understand. So I'm not sure we can really read too much. But I mean, regardless, AAS, Aberdeen Asia Focus, has already declared a change in their dividend policy. So it's already declared a large increase for next year, even though they decreased it in 2021. But they've already announced a big increase in the dividend, a lot of which is based on just them deciding to change their policy. Their policy is going to go to having lower dividend cover, and actually probably regularly paying their dividend out of capital reserves. It's just something they've decided to do to make the trust look more attractive. So actually, going to a covered dividend for AAS isn't even in their plans. So going for a covered dividend in this one, the growth needed of 100% is kind of irrelevant, because they're kind of not caring about that anyway. Anyway, there we go. Have fun, guys. See you next time. Bye-bye.